All right, we're live. We got a great video we're going to go over right now. And if you're thinking about buying a home, you may want to got a pad, a paper, maybe something to write down with because got some great information here that I'm going to share. Over the last 2 decades, I've been in the real estate industry. So serving clients is my where my heart's at, and that's why I put on these videos. So I'm hoping that you're able to take at least a few things away from this video and put it to work. And that way, if you're thinking about buying a home, it's going to be a smoother process for you. So let's take a look at that. There's actually 5 areas. What we're really going to go over today is the 5 areas what lenders look for in a mortgage application. So when you're applying for a home loan, this is it. This is what lenders are looking for. And really what it's not so much what I think, it's really what the underwriter thinks. Okay. So even though I've been involved with thousands of transactions over my career, I got pretty good at what underwriters are looking for and how they think. So I like to say that I like to put on my underwriting hat, and that's what we're going to go over today. There's so much to learn about underwriting. This is not a crash course to be an underwriter. This is not a crash course to be a loan officer. This is really just to help home buyers, achieve their dreams and just get a little bit more information behind what it takes to buy a home. So that's really what this is all about over here, because in order to be an underwriter, no one just starts off to be an underwriter, by the way. A lot of times they become loan officers, or maybe they become processors, and then they work their way up. And then they get their first position as an underwriter. And I've been an underwriter before, so I kind of know the routine. And then eventually they start working on some files, and they become a senior underwriter. And there's a lot of things to learn in this field. So we're just going to keep things very simple, though. We're going to talk about the 5 most important things that the underwriters look for. Okay, so by knowing this information, I think it's going to help you do is become more knowledgeable in this area. So that way, if you're thinking about getting pre-qualified, you're going to just get pre-qualified with more accurate information. And also, it's just going to prevent any last minute, deal blowups, right? The better we do at the very beginning, the better the results that you're going to have. And then also, you're going to be able to set expectations with the real estate agents, the home sellers out there, right? That's going to give you the ability to close faster with a lot less stress, which we all want to happen. But we got to think about this. These mortgage companies, they're going to give you hundreds of thousands of dollars a lot of times. So they've got a thorough checklist. I've seen some of these checklists, and some things, sometimes there's pages long of these checklists, and the checklist, there's different stages as well. So, lender thinks these certain categories or buckets as risk, right? That's the bigger picture. And they might take a look at your documents, your credit scores, things like that. But they're asking one question: is this borrower a reasonable risk for this loan program, right? So aside from your credit scores, because I've seen people with great credit, and then the underwriters maybe second guess the employment, right? So credit's not everything. And then there's so many different programs out there. Like there's thousands of programs out there, right? There's thousands of programs, hundreds of different wholesale lenders, banks, credit unions, all that sort of stuff. So they have their own little niches on what they do. And that's really like one of the benefits of a broker. We have all these different ways and access to this type of financing. So if it doesn't work over here, we can go to over there, right? So, but let's go to step number 1. Step number 1 is income and job stability, right? This is usually, and most of these guidelines I'm referring to right now is typically on the conventional side. But there's also FHA and also what they call non-QM. These are non-qualified mortgages that don't get qualified for, we'll just say for conventional loans or FHA. So these are loan programs that fit outside the box, right? Maybe self-employed buyer is writing off a lot of expenses. They make the income, but based on their tax returns, we have to go looking at a non-QM program, such as maybe a bank statement program, right? This is not going to pertain so much to all these different programs like that, the non-QM, because there's hundreds of different non-QM lenders. And this is what I do for a living. I study these guidelines day in, day out, right? So I'm really familiar with the different programs out there. But what we're really focused on is how a conventional underwriter is going to be looking at your file. And some of those conventional guidelines, they kind of overlap, with the FHA, but not really. There's some different things with FHA can do that conventional can't do. Okay. So this is where a really good loan officer knows the different guidelines on where to properly price out that loan and submit that loan. So that way it goes submitted to approval to closing really, really fast. So that way there's no hassles in the process. But let's look at the job stability. This is really important. On average, I would say most underwriters don't like to see more than 5 jobs in the last 2 years going. So if it's less than that, it's even better because it represents more job stability. If once you get above 4 or 5, then that's where it's questionable. But there's certain industries that do allow it. So again, it's just 4 or 5 on average, but there's certain industries that do allow it. And, we're very familiar with those industries, and it varies from occupation to occupation. So what we want to do is we want to just take a 2-year history. Okay. 2-year history. What we're going to be looking at is a type of income. Are you salary or hourly? Do you receive any bonuses or commissions? And there's guidelines that wrap around that to see if you can use that as income to qualify. And of course, there's self-employment income. You could be a sole proprietor. You could have an LLC. You could be a partner. There's a lot of variables that go along with that. It's almost like variable income, right? The only non-variable income is more steady, like you receive a pension or you receive a salary or hourly. That's more locked in. That's not variable income. So they look at variable income versus non-variable income as well. And then the consistency, is it, did the person go from, one job to the next job and it's in the same line of work? Sometimes that can make a little difference as well. And a good loan officer is going to paint a picture that it's all related, right? That way it's consistent on your growth. So that might be a possibility. But again, these are things that the underwriters look at. And at the end of the day, is this income likely is going to continue, right? Could you imagine if they sent out a verification employment to the employer and the employer puts on a verification employment, this person is has no likely to continue, right? And just that word alone can really make a difference on that verification employment if it's going to get qualified or not, because they're just not likely to continue, right? Maybe that person is going from full-time to part-time, right? And they have to announce it now in that verification employment. So we like to get those verification employments early on in the process, okay? 99% of lenders out there, loan officers, they wait until you're in escrow. So what we do is we do it at application to avoid any surprises, because we want to make sure this is a smooth process for all parties involved. And also maybe, somebody that's looking at a higher FICO score, can that help? Kind of, right? We're going to touch on that right now. So when they take the income, though, they're going to be looking at the overall debt, right? So the debt also includes the housing payment, the principal and interest for that mortgage, the taxes and insurance, right? And also if there's mortgage insurance. So depending on the loan and the down payment. And then also they're going to look at if their property has any HOA, right? Homeowners Association fees. So if it's a condo or a PUD, a planned unit development, a townhouse, they may have HOA. Even a single family residence may have HOA. So we want to take a look at all that. And sometimes in certain areas, you could even have, Malaroos or supplemental taxes. So they're going to look at all taxes, combine all that stuff, and that's going to be considered your housing payment. Then they're going to look at your monthly liabilities, your debts, such as your car payments, credit cards, student loans. Even if you're not paying any payments and those student loans have been deferred, yes, they're going to take that into account. That applies across the board on all loans, by the way. And then they're going to look at your gross monthly income. And there's ways that there's different ways that they calculate that gross monthly income. So it's just not like 1 + 1 = 2. There's certain formulas that they're going to use based on your type of employment, how often you get paid, if there's bonuses, commissions, how often of those things are paid out. So there's some variables that go along with that to calculate the gross monthly income. But once they get the gross monthly income, then they're going to take that that income. They're going to take the debt over the income and come up with a ratio. So on conventional loans, typically I see them going up as high as 45 to 50%. No more than really 50% on conventional loans. But it's all based on the credit scores and also the down payment a lot of times, right? So somebody with a lower FICO score, they may not go up to 50% on debt to income ratio. They might be capped at 45. We don't really know. There's no real book on this part. We actually have to submit this to figure out if you're going to qualify or not through what we call the desktop underwriter, okay? And the desktop underwriting system, it's an automated underwriting system that we run it through. And when we run it through there with the income, and this is really important that the income is calculated correctly, and that way there's no errors in there. That way, it's going to be the same exact income that the underwriter is going to use to qualify. Because if a loan officer overstated the income based on what the underwriter is going to say, the underwriter is going to cut that income, and now that client's buying that home, and they're in trouble, right? This is where a lot of times they fall out of escrow, right? Meaning falling out of escrow is not a good thing because you put a deposit in there, and if whether you have contingencies in there, not in there, whatever, we'll leave that, in full disclosure. That's something that you're gonna have to work with the real estate agent to make sure that they're fully protecting your deposit as well as your loan officer. But your deposit's at risk at the end of the day, right? So you want to make sure that the income's calculated correctly. The underwriter, it's the same exact income that the underwriter is going to be using, as well as your debts. So that means full debts are disclosed. Most of the time, these debts are disclosed on the credit report. But what we do is we run the credit. We also look at that, and we also go over a credit report call, right? Making sure that we're not missing anything on that credit report. Maybe something's not being reported, and it does get reported during the process. Seen that happen before. So that's why we do a credit report review with the clients to make sure that all that stuff is being accurately reported. Now that everything's accurately being reported or calculated, with the incomes calculated correctly, the debts are 100% accurate. Now we can come up with an accurate DTI. That's the debt to income ratio. That way there's no surprises when the underwriter touches a file. So that's step number 2. Step number 3, we're just talking about credit. It's not just the credit profile. Lenders look beyond that. And again, when it runs through the AUS system, the automated underwriting system, the AUS system is also going to look at the trade lines as well, right? So, I've seen people with high FICO scores not get qualified because they just didn't have the proper trade lines. So, and then I've seen people with high FICO scores with minimal trade lines still get qualified. Again, it's all based on, there's some factors in their credit profile as well as what the AUS system's looking at. I've been doing this, 2 decades, so I've probably reviewed thousands and thousands upon thousands of credit reports, by the way. And pretty good. I'm really good at just identifying, that might be an issue right there. And whenever there's little red flags, I like to get on the phone with the client right away to go over things like that. But a couple things that the AUS system's looking for is a payment history, late payments, revolving utilization, recent inquiries on new credit cards, new accounts, collections, charge-offs, and just the overall credit behavior, right? So that's the credit profile. That's how we look at the credit profile, and that's what the AUS system is going to look at, as well as the underwriters. Assets and reserves. Step number 4. This is a big part of somebody buying a home. Technically, you can buy them with minimal down payment. Like, there's a variety of different programs out there with minimum down payment. So there's, down payment options out there available. But then there's certain loans that do require reserves. So that's a terminology that you definitely want to know. Is you want to know the down payment, how much. You want to know the closing cost. And number 3, you want to know how many reserves are going to be required. And that's really the money of payments that are left over after closing. So let's say the loan requires 2 months reserves and your mortgage payment is $1,000. So technically, after all your down payment, after your closing costs, after everything, after you told everything you pay for, the underwriter is going to want to see 2 months of reserves. That's $2,000, which is 2 months of the mortgage payment left in your bank account. Not every loan is going to require the reserves, but there are some loans that do. So these are the three things that you want to pay attention for. And those are three things that the loan officer would want to go over with you, right? They want to go through your down payment source, what kind of money that you have for closing costs. They want to review the closing costs with you, right? And they also want to review reserves. So those are the three things right there that are very important when it comes to assets and reserves. Assets are liquid assets, right? Money, checking account money, savings account money, 401k, stocks, bonds, stuff like that can be used as assets. A vehicle cannot be used as assets. Things like that, right? There's certain, like, you can't just sell the car per se, but you can liquidate a 401k if you had to. So a 401k you can use, pension funds, things like that. You can definitely use life insurance. That's a good question. I always get that question sometimes. And depending on the life insurance, you may be able to use that as well. So you just want to submit all those documents so that way they can figure out if you meet the asset reserve requirements. So that's number 4. Number 5 is the property and appraisal. Okay. This is the last one right over here. A lot of times when you're buying a home, you may not have the property in mind. That's no problem, right? So what we just talked about, the first 4 most important things about the loan application prior to going under contract. So those are the 4 things right there. Number 5 is the value of the home, right? So they're going to look at the value of the home, the condition of the home, okay? They want to make sure that the value and the property condition are going to be acceptable for the loan program. And really what they're looking at is like, hey, if we had to sell this home, could we? And what value do we give it? So they take at the value of the property minus your down payment. That's approximately like your loan amount, okay? And it's just some basic math right there. But those are the 5 things right there that you want to consider when applying for a mortgage, right? You may not know the property or the appraisal, but know that every loan, for the most part, are going to require an appraisal inspection. And that's money that you're going to have to, let me rephrase that again. Okay. An appraiser is going to go out there and appraise a property. Okay. And there's a fee that is associated for doing that. And that fee can range from, $500 to $700. Okay. Just depending on the size, the bigger the property, and also location, then of course the value of that appraisal inspection is going to go up. So they're going to go out there and value the property for you, but also for the lender too, right? Because the underwriter doesn't want to lend anything more than what the value of the property is worth at that given time frame. And then for your sake as well, like, you don't want to spend anything more than the value of the home, right? I know people that buy a home cash, and guess what? They still get the appraiser to go out there to do an inspection just to make sure that they're not overpaying for the home. So that's property and appraisal, number 5. So why does this matter to you if you're an agent or a buyer, right? You're not relying on just surface levels, pre-approvals, meaning like, how well did the loan officer do work with that home buyer? How well did they do? Did they dot every I, cross every T, right? If you're a buyer, that can give you a lot of confidence knowing that the loan officer dotted every I, crossed every T. Keep in mind, to do one of these types of approvals requires a lot more work for the loan officer to do. And that's why typically they don't do them. They'll just give you a pre-approval really fast. Here you go, and you're off running around. But there's a lot of things that are missing off that to actually validate that approval as if it's the underwriter doing it. So that can really cause issues down the road. And on top of that, when you're starting to submit offers, home sellers want to know, let's be honest, have you been fully qualified by an underwriter? Because if it's not fully qualified for the underwriters, there could be some surprises. And most home sellers probably don't want to work with a pre-approval that way, right? They want something that's been pre-approved by an underwriter. There's just less things to go wrong. And so that's why it's very good to have one of those pre-approvals that the underwriter actually reviewed. And that way there's no surprises. So, you know, I believe this, that the best agents just don't sell houses out there, right? So teaming up with a really good agent that's going to help you with this process, but they have to have enough understanding, like through the financing, well enough to guide you, the buyer, confidently, right? That means they got to make sure that they got the right lender. But it's not the lender, it's the loan officer in the system that produces fast results. It's the loan officer and the system that produces great results, right? Meaning less hassle, right? So finding a loan officer that's going to allow that home buyer, right, have a smoother transaction. So if you like a free guide, it's the Ultimate Home Buyer's Guide. And if you're a home buyer watching this, I want to give you this home buyer's guide. It's the Ultimate Home Buyer's Guide, free, no obligation, right? And this guide is going to actually help you prepare for homeownership. Just give us a call at the office or shoot us a text. You can just text us, right? Or visit us at the website at freedomchoicelending.com. The phone number where you can call or text is 866-587-6927. And you don't have to talk to anyone. You can just send us a text saying, hey, I would like to get the free Ultimate Home Buyer's Guide. And we can send that out to you free of charge. We'll mail it out to you so you have it right there in front of you and you can work on this. So as you work on becoming a homeowner, or maybe you own a house now and it's been some time since you last purchased the house, right? Things have changed since then. Things are constantly changing in the industry. So I encourage you as well to get a copy of this, the Ultimate Home Buyer's Guide. So that way, next time when you do buy that home, it's going to be a smoother process, hopefully better than the first time. And again, the phone number is 866-587-6927. Thanks for watching. We'll see you back soon. And if you saw this on YouTube, just subscribe today if you want to get more alerts on the pre-approval process, on how to beat out other buyers to the best new listings, getting your offer accepted the first time. A lot of other great information. Just subscribe today. Thanks for watching, and we'll talk to you soon. Bye-bye.